Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph Show. If this is the first time you've joined us, I want to say welcome to the show. This is a show we do every week. We talk about all kinds of topics, generally business related, tax related, things like that. Well, today we're going to talk about estimated tax payments. You know, these are those dreaded things that sometimes if you work with an accountant, they say to you, well, listen, you know, now that you're owing money at the end of the year, we need to start talking about estimated taxes. And truth be told, you know, in my practice, you know, we do a lot of tax returns. And this time of year, now that we're getting into the beginning of April, most taxpayers are starting to realize that, you know, they're going to owe taxes this year. Now, for most people, they really don't have to worry about filing estimated taxes, and that's because their taxes are withheld right from their paycheck. So I'll start by saying, you know, in general, if you are one of those people who are a typical worker bee and your employer is withholding taxes, this probably is not going to affect you. In fact, for the most part, in those cases, you generally are getting a tax refund because you usually end up overpaying. But now, there's many taxpayers who don't have any money withheld from their paychecks at work, and for them, it's necessary to make these estimated tax payments. Now, why do you do that? Well, to be honest, you do that to avoid interest and penalties. Well, that seems pretty straightforward, doesn't it? So let's talk a little bit about what's behind this. Let's talk about the rules governing IRS estimated tax payments. Rules governing the IRS requires taxpayers. Now, this is an article that I found on the Motley Fool. It says the rules governing the IRS require taxpayers to make tax payments throughout the course of the year. For most people, job income makes up the vast majority of what they make, and the requirement that employees withhold federal income tax on their employees' paychecks is designed to ensure that most workers have enough of their money going towards prepaying their tax throughout the year. So you've really got two issues. You've got some people that don't have their withholding set correctly, and they end up owing. And then we have some people that, you know, don't have any withholding at all because let's say they work for themselves. Now, a third thing that can happen is let's say that you've got a lot of passive income. What I mean by that is let's say you've got some investments or you've got, you know, retirement accounts and things like that where there's no easy way to withhold taxes. And a lot of times that could be something, you know, might not be federal estimated taxes. It could be state estimated taxes. So how do you figure out, you know, what's enough? So here's some IRS rules to live by. If your tax bill will be less than $1,000 at the end of the year, then you won't owe any penalties for underpaying your taxes over the course of the year. So you don't need to worry about making estimated tax payments. In addition to that, if you pay at least 90% of your current year tax bill through your withholding, then you won't owe a penalty either. That's true even if your taxes are high enough so that the remaining amount exceeds $1,000. Now, that threshold was dropped from 90% to 85% with the 2018 tax year because of the complications related to tax reform and all the rules that came into existence. And in fact, you know, the IRS is apparently aggressively waiving these penalties this year because of how many people who have issues with their withholding. There's also a third possibility if you don't meet those first two. That's it's less than $1,000 or 85% of the previous year. If you have tax withheld that's at least 100% of what you ended up paying in total taxes last year, then you're generally able to avoid penalties. Now, a little bit of a caveat to that. If your income exceeds $150,000, that amount goes up to 110% of your previous year's tax bill. And that's important. So what they're basically saying here is if you are at least paying in as much as you paid in last year, you really don't have an issue here. And a lot of my clients just say, you know what, Ralph, I'm not even worrying about it. If I owe them money at the end of the year, well then I'll pay them at the end of the year. They'll get what they get. And I just have to let them know, you know, you may pay a little penalty by doing that, but at the end of the day, you know, that's up to you. So when do you have to make these estimated tax payments? They basically do 4 times a year. As their name suggests, well, there's not rocket science, right? The first is due April 15th with your tax return for the previous tax year. Then they're due on subsequent days of June 15th, September 15th, and January 15th. Now, I will tell you the same thing I tell clients. Those dates are the general rule. But if you're not going to meet those dates, it's not a big deal. So just do what you can. Now, so what's the price of not making these estimated tax payments? And it really depends on the prevailing interest rates and how much you should have paid. And that's where it gets complicated. And I got to be blunt with you. We have tax software that figures out this calculation because it's charged on a daily basis depending on how late you are and when you should have made those payments. And I'm not even going to try to go down that road. So what happens if you don't pay your taxes? Don't pay your estimated taxes. If you discover this year that you should have paid estimated taxes, it's generally too late to fix the past. Well, that makes sense. It's too late to do it now. But what you can do is make sure you're doing it moving forward. And that's where it really comes down to speaking with somebody like myself. And, with my clients, one of the things that we generally do is when we sit down and go over your taxes, let's say that we work up your tax return and you owe, $3,000. And then what I'm going to do as a, professional accountant, you're not going to get this from the big box store accounting area, tax preparation houses. They just don't have the ability to do this. We're going to sit down and put together a tax plan. And frankly, I think that's more valuable than somebody doing your tax return because, it's really easy to do a tax return, and put on there what happened before. But the value in working with a professional accountant is planning for the future. And that's something I'm very good at. And it's not just me. There's a lot of good accountants out there that can do this as well. But what we do is we sit down and plan, what does this next year look like? And then we'll develop an estimated tax plan based on, some assumptions. Let's say, for example, that you're retired and, you've got income from, stocks, bonds, mutual funds, interest. Let's say you're taking some required minimum distributions. Well, we can take a look at what your total income is going to be. And then we can back into your estimated taxes to make sure at a very minimum, you're not going to get hit with any penalties. And for most people, that's good enough. They want to make sure that, hey, worst case scenario, I don't get hit with a penalty, Ralph. I feel like I'm doing my job if I can get them within $500 of either getting a refund or owing. Now, I have some clients that, they don't want to take that risk and, they want to make sure they've hedged their bets. So we might pay a little bit more in estimated taxes. And then if you're a business owner, I'm going to be honest with you. Like I'm not a big proponent of paying estimated taxes in the first 2 quarters if you're a business owner, because you never know what the business is going to do later in the year. Now, that being said, so if I'm a business owner, I'm really advising you to make those payments as you get closer to the end of the year. But I hope this was helpful today, talking about estimated tax payments, because a lot of people just don't understand how this works. And you just have to have, some confidence in the person you're working with to make sure, they're looking at a tax plan for you for the future so that you don't have any underpayment penalties at the end of the year.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.